Banking confidence has recovered significantly, rising from a weak 38 index points in the first quarter of 2011 to 58 in the second quarter. Joining me now in studio to discuss the banking index is Emilio Pera, who's the lead banking and capital markets director at Ernst Young. Emilio, great to have you in studio. Last time we spoke, we know that the retail sector and retail banking looked very dismal. The investment side of things seemed to be looking far better. We're seeing a far better number coming through for the second quarter of this year, and it seems that we have seen a recovery finally coming through in retail banking.
Absolutely. As you mentioned, investment banking has seen a more positive trend over the last 4 quarters. It's showed a steady improvement. Retail banking in the first quarter of this year was at its lowest level ever and has picked up significantly.
Record lows, in other words.
Record lows, absolutely. And we've been doing the survey for the last 9 years. But has picked up quite nicely in the last quarter.
Well, given the fact that we have seen a nice recovery in retail banking, where are we relative to historical numbers? And as you alluded to, off very low levels, clearly.
Yes. As I mentioned, we've been running the index for the last 9 years, and that includes the very buoyant period from 2003 to 2007. The credit crisis obviously had a significant impact on confidence levels, and it has been edging low from 2007. Very low levels up to the last six months for 4 quarters for investment banking, 2 quarters for retail banking, and we're starting to see that the fundamentals are starting to improve.
Okay, well, fundamentally, we know household debt to income is still at very high levels.
Absolutely.
We've got subdued inflation at this point, which is positive for the consumer,
yes.
And we've got 30-year low interest rates in the country. Are you
yes.
surprised that we still haven't really seen momentum picking up within the retail banking space?
It has been something that we've been expecting for the last year, and it hasn't picked up, and it was quite a surprise in the last quarter that it went to such low levels. However, what we seeing as reassuring is some of the indexes, consumer index, vehicle sales compared to the same period last year has improved significantly. Also, impairment losses has come down for both retail and investment banks, which is also a positive trend. But as you correctly say, the levels of indebtedness is still at very high levels, which from a credit appetite perspective shows limits.
Yeah, well, it's fascinating because we've got a low interest rate environment and it hasn't really resulted in an increase in credit extension.
Yes.
Do you think it's reluctance from the banks at this stage where they're still very worried about lending to the consumer, or is it just a lack of appetite?
I think consumer indebted levels, if you take the National Credit Act, does limit the credit exposure, but also I think certain segments of the market, for instance the housing market, uncertainty there around the security is also potentially an indicator as to why banks are more reluctant to lend in certain areas.
So do you think that the banks are still very concerned about a recovery, a sustainable recovery, a meaningful recovery in the property sector?
In the property sector, definitely is still the case, but we are seeing that income levels are starting to improve, and as I mentioned, asset-backed finance through vehicle finance, etc., are definitely showing an improvement.
With regards to investment banks, we know that they have faced volatile markets, and I think that's the name of the game, and even perhaps going forward. But then again, we are still sitting at above 30,000 levels on the JSE All Share. We're starting to see equity markets recovering. Where are we sitting with regards to investment banking at this stage, and how much risk is being priced in?
Investment banking has shown improvement in all categories, with the exception of treasury operations. So I think trade finance, specialized finance, corporate finance have all shown significant improvement and consistent improvement over the last couple of quarters. But it is very dependent on global markets, as we saw last year, and with uncertainty around Greece and the Eurozone, I think that is a risk that will have an impact if there's a negative global trend.
Well, I mentioned a little earlier that Moody's is actually focusing on the fact that the 3.5 trillion yuan local government debt exposure that banks have over in China could actually be a negative down the line. And we keep seeing banks in the corporate sector starting to have sovereign debt exposure, and it's evident in Europe, it's starting to become evident in the US as well. If we do see things falling apart on a global level in other economies. Could that feed through into the South African sentiment banking scenario too?
Definitely in the investment banking side, we have seen through the credit crisis that the investment banking is definitely more directly impacted through global sentiments. And it is partly because of trade flows, which is very dependent on global activity.
Let's look at the overall scenario that is going to play out in the second half of 2011. What are you pricing in? Do you think that, again, it's going to be a relatively flat number? Can we maintain the gains that we've seen on the banking confidence side of things?
I think if dependent on what happens globally, but if you look at local environment, steady improvement, the fact that, as you mentioned, with a relatively or low interest rate environment, impairment losses reducing, we can see credit extension starting to improve, especially in the corporate sector. Investment banks are starting to re-employ. It is definitely positive indicators and bodes positively for the next 6 months.
In terms of retail banking though, and again we focus on the consumer, if we do see an interest rate hike, and it seems that a lot of investors and analysts out there are pricing in an interest rate hike by the end of the year, some say it's only going to happen early next year. Is this going to have an impact on the retail banking side of things, or do you think consumers are starting to brace themselves for that hike already?
I think if you look at the levels of indebtedness, it will definitely have an impact, although banks have also been focusing on cost containment and looking at the bad book and credit losses. I think a lot of that is already positioning for that increase.
Okay, we're all wondering when we're going to see double-digit growth coming through for the banks. What are you pricing in by way of double-digit growth before the financial crisis hits, and of course clearly before the National Credit Act was implemented? Do you think we could see growth of between 15 and 25% going forward?
I suppose if you look at the global regulatory environment that banks have to position themselves for, it's not very likely. And I suppose if you look at the growth and dependency on where global markets are going, I suppose those uncertainties we have to contend with.
Okay, fantastic. And just one last thing, when you, and I allude to again to the macroeconomic environment that is playing out. We've got US debt ceiling, which is under the spotlight. We've got the debt burden overhang, which is plaguing a lot of the banks in Europe. We know that Moody's and S&P has said any voluntary rolling over of Greek debt is actually default, and we know that French and German banks have agreed to this. So what do you think is going to happen by way of sentiment on a global level when it comes to the banking scenarios? Do you think, again, that most investors are very cognizant of the negative rhetoric as well as the positive?
I think definitely the banking sector globally is integral part of the points that you just mentioned. I think if you look at the regulatory change that we're seeing coming down the line, banks are repositioning themselves to align to that, and I think banks will be forced to remain competitive. They need to revisit their business models.